Welcome back to Module 1 of our Blueprint course. In today's Lesson 5, we are diving into the decision process, an essential step in your trading journey. In the previous lessons, you have learned how to identify the trend and determine the location of an asset. Now, it's time to take the knowledge a step further. In this lesson, you will learn how to decide which actions to take based on any combination of direction and location. At first, this might sound a bit complex, but don't worry. We will break it down step by step. By the end of this lesson, you will also have a cheat sheet that summarizes everything in one convenient, easy to follow overview. Let's get started. At first glance, this slide may seem a bit overwhelming, but it's actually quite straightforward once you understand its structure. Think of it as a decision matrix, moving from left to right. It starts with step 1, identifying the higher time frame HTF location. Next, we move to step 2, assessing the trend direction. Finally, we arrive at step 3, performing the lower time frame LTF zoning process to establish our trade setup. This slide essentially answers the question, what action should we take based on the location of our LTF zones in relation to the HTF context? Let's walk through an example. Imagine our LTF supply zone is positioned high or very high on the chart relative to the HTF. If the HTF is in an uptrend, the profit margin for this setup is low because we would be trading against the trend in a supply zone, which is inherently riskier. If the HTF is in a sideways trend, the profit potential improves slightly to medium, as a sideways trend allows for both buying and selling opportunities, but it's still only moderate compared to trading with the trend. Now, if the HTF is in a downtrend and our supply zone is positioned high or very high, this is where we see the highest profit potential, as we are trading with the dominant trend in the ideal location for a sell setup. Let's now discuss the probability of success for these scenarios. Trading with a trend, an eagle selling supply in a downtrend, yields the highest probability of success, as it aligns with the overall market momentum. Trading in sideways trend offers a medium probability, as the market lacks a clear directional bias but can provide opportunities within its range. Counter-trend trades, such as selling supply in an uptrend, have the lowest probability of success, as they work against the prevailing market forces. By combining location, trend direction, and LTF zoning, this matrix allows us to evaluate both the profit potential and the probability of success for each trade setup systematically, and the probability of success for each trade setup systematically. This framework ensures our trading decisions are aligned with market conditions and based on logic, not guesswork. Let's go through each scenario in detail. In our first scenario, we are positioned high on the chart, but are considering a counter-trend trade, trading against a primary uptrend by focusing on the LTF supply zone, because we are trading against the stronger momentum move of the uptrend. The profit margin is limited or low, and the probability of success is also low. Counter-trend trades typically carry greater risk and offer less favorable outcomes because they work against the dominant forces driving the market. Now, compare this to trading with a trend. For instance, if we aligned our trade with the impulse move of the uptrend, we'd likely have a higher profit margin and greater probability of success. This is because the trend's momentum would be supporting our trade, offering stronger and more reliable price movement. This distinction highlights why aligning with the trend whenever possible is crucial for improving both profitability and success rates. However, understanding when counter-trend trades may still be worth taking and their inherent limitations is equally important for a well-rounded approach to trading. In the second scenario, the only variable that changes is the direction of the trend. This time, we have identified a lower time frame, LTF supply zone, positioned high on the chart. But now it is within the context of a higher time frame, HTF sideways trend, and a high location on the HTF. If we were to set this trade, we would recognize that the profit margin is medium. It's slightly better than a counter trend trade in an uptrend, but it's still not the ideal situation. In a sideways trend, price tends to oscillate between supply and demand zones. So there's potential to capture profits, but the opportunity isn't as strong as trading with the primary trend. Similarly, the probability of success is also slightly higher than in a counter trend trade, as a sideways trend provides more neutrality. However, it's important to note that there's still one scenario: trading with the trend in alignment with a downtrend. That would offer an even better combination of profit margin and probability of success. In this context, while the trade may be worth considering, it's crucial to weigh the risk and reward carefully. A medium profit margin and a probability of success can still result in profitable trades, but they aren't the most optimal setups compared to trend-aligned opportunities. This is the best case scenario when it comes to higher time frame context, or in other words, the big picture alignment. Let's say we have identified a lower time frame, LTF supply zone, located high on the chart, within the context of a higher time frame, HTF downtrend. This setup represents the ideal trading scenario for both profit margin and probability of success. Here's why. Profit margin. In a downtrend, price tends to move consistently from HTF supply zones to HTF demand zones. A supply zone positioned high on the chart gives us the maximum room for price to drop, creating the best profit margin. This means we are aligning with the dominant trend and capturing the stronger impulse move. Probability of success. Trading with the HTF downtrend significantly increases the likelihood of the trade working out. The momentum is on our side, and the location further reinforces the setup, as it's in the high or very high range of the HTF. By trading lower timeframe supply zones within the context of higher timeframe location high and a downtrend, we align every element of the trade with the market's natural flow. This combination of trend direction, location, and LTF zone quality creates a high probability, high reward setup, the kind of scenario every trader aims to execute. Now that we have covered all three scenarios for a high location, let's review the different options we have when finding ourselves low in location. This slide outlines the actions to take when our lower time frame, LTF demand zones, are located low or very low on the chart, depending on the higher time frame, HTF trend direction. If the HTF is in an uptrend, and our LTF demand zone is positioned low or very low, this setup represents an ideal scenario. By aligning with the primary trend, we are trading in the direction where price is most likely to rise. Being in a demand zone at a low price in an uptrend maximizes both the profit potential and the probability of success. This is a perfect combination for high quality setups, offering the best chance of a strong momentum move to the upside. If the HTF is trending sideways, an LTF demand zone located low or very low still offers a reasonable opportunity, while it's not as strong as trading with an uptrend. The location at the low end of the range provides a moderate profit potential. The probability of success is also medium, as price may oscillate with the range, offering opportunities but with less directional momentum than a trending market. In a downtrend, An LTF demand zone positioned low or very low presents the least favorable scenario. Here, we are trading against the dominant downward trend, which reduces both the profit potential and the probability of success. Counter-trend trades like this carry significantly higher risk, as price is more likely to break through the demand zone and continue lower. In summary, trading demand zones in an uptrend provides the highest potential and probability for success, as it aligns with the trend and location. A sideways trend offers moderate potential and probability, as there's no clear directional buyers but opportunities within the range. Trading against a downtrend offers the lowest potential, as it goes against the dominant market forces. Understanding how to position your trades within the broader market context is crucial for optimizing both profitability and success rates. Let's again have a look at each scenario in detail. Let's put this into a visual context before diving into practical application. Imagine we have just completed our analysis, and here's what we've observed. Current price location. The price is situated low or very low in terms of the higher time frame HTF location. Trend direction. We have identified an uptrend on the HTF using our objective direction analysis tools. Lower time frame LTF zone. A demand zone has been located on the LTF, aligning perfectly with the HTF low location and the uptrend context. If we now wanted to set this lower time frame demand zone, it's important to evaluate two critical factors. Profit margin. In this setup, the profit margin is ideal because we are trading in a demand zone located at the low point of the HTF chart in alignment with the uptrend. This means there's significant room for price to rise, offering maximum potential returns. Probability of success. This scenario also provides the highest probability of success, as we are trading with a dominant trend and within a high quality location that aligns with a broader market context. In summary, trading LTF demand zones within the context of HTF low location and a higher time frame uptrend represents the perfect combination. This setup maximizes both profitability and the likelihood of a successful trade by aligning with the natural market flow and institutional activity. This is an ideal scenario that every trader should strive to capture. In this second scenario, the only change is the direction or trend of the price. This time, we have identified a lower time frame LTF demand zone within the context of a higher time frame HTF sideways trend and a low location on the HTF. If we were to set this trade, here's what we would evaluate. Profit margin. The profit margin would be medium, while the LTF demand zone is positioned in a favorable low location. The absence of a clear uptrend means the trade doesn't benefit from strong directional momentum. However, the sideways trend does allow for opportunities as price tends to oscillate between demand and supply zones, providing a better margin than a counter-trend trade. Probability of success. The probability of success in this scenario is also medium. It's slightly higher than in a counter-trend trade because a sideways trend provides more neutrality, allowing for both buying and selling opportunities. However, it's not as strong as a trend-aligned trade, where the dominant market forces work in your favor. While this setup is not the best case scenario, it still offers reasonable potential. Trading in the context of HTF location low and a sideways trend can provide decent opportunities, but it lacks the higher probability and profit potential of trading with the trend. Understanding these distinctions allows you to make more informed decisions based on the context and trade-off between risk and reward. This scenario represents the worst case scenario in terms of higher time frame HTF context. Essentially, the big picture misalignment. Let's say we have identified a lower time frame, LTF demand zone, located in the low context of the HTF. But the HTF is in a downtrend. Setting this trade would result in profit margin. The profit margin is minimal or low because we are trading against the prevailing downwind momentum of the market. In a downtrend, price is more likely to continue moving lower, making it difficult to achieve significant gains from a counter-trend trade in a demand zone. Probability of success. The probability of success is also low, as counter-trend trades inherently go against the dominant market forces. The downtrend creates a strong headwind that reduces the likelihood of the demand zone holding. Counter-trend trades, whether it's trading supply in an uptrend or demand in a downtrend, consistently offer the worst HTF context for a trade. These setups lack both the alignment of location and the support of the broader trend, making them high risk and low reward opportunities. On the other hand, the best HTF context will always come from trend trades, where we trade demand in an uptrend or supply in a downtrend. These align the HTF zone with the HTF trend and location, maximizing both profit potential and probability of success. By focusing on trend trades, we ensure that we are trading with the flow of the market rather than against it, significantly increasing the quality of our setups. Now to conclude, let's look at the third and last possible location, equilibrium. This is a final action slide before we bring all the strategies together into one summary. Here we are focusing on what actions to take when lower time frame, LTF zones, whether demand or supply, are positioned in equilibrium on the higher time frame HTF location. If the HTF is in an uptrend and our LTF zone is located in the equilibrium zone of the HTF, the profit margin is medium. While trading from equilibrium doesn't provide the same potential as zones positioned at extremes, high or low, it's still a viable setup. In a strong uptrend, prices may not pull back to the extremes often. So equilibrium zones offer a chance to trade with the trend. However, both the profit margin and probability of success are slightly reduced compared to zones positioned at HTF lows. When the HTF is trending sideways and the LTF zone is positioned in equilibrium, this context does not offer a viable trade setup. The combination of a neutral trend and equilibrium location lacks sufficient profit margin and probability of success. Trading in this context is generally inadvisable, as the market lacks the momentum required to support a high-quality trade. In the context of a downtrend, if the LTF supply zone is positioned in equilibrium, it's possible to trade this zone with the trend, while the profit margin and probability of success are not as high as trading a supply zone positioned at an HTF high. This setup remains reasonable. The key is that the downtrend provides enough directional force to support a trade, even from equilibrium. Trading from an equilibrium location is acceptable when aligned with a strong uptrend or downtrend, as it allows participation in the trend even if prices aren't at extremes. However, the potential profit margin and probability of success are moderate rather than optimal. In contrast, equilibrium locations in a sideways trend do not offer enough opportunity and should generally be avoided. This framework ensures that we can still engage with trending markets, even when prices consolidate in equilibrium, while avoiding low-quality setups in non-trading environments. Let's look at each of the three scenarios in detail. Let's put this into a visual context before moving into practical application. Imagine we have completed our analysis, and here's what we've observed. Current price location. The price is positioned in equilibrium in terms of the higher time frame HTF location, trend direction. Our objective tools have confirmed an uptrend on the HTF. Lower time frame LTF zone. We have identified a demand zone on the LTF, which aligns with the HTF equilibrium and the HTF uptrend. If we now wanted to set this lower time frame demand zone, it's essential to evaluate two key factors. Profit margin. Since the LTF demand zone is positioned in the equilibrium, the profit margin is medium. It's not as favorable as trading from a low location, but it still offers a reasonable opportunity as the price has a potential to continue higher in alignment with the HTF uptrend. Probability of success. The probability of success is also medium. While trading with the uptrend improves the odds, the equilibrium location slightly reduces the likelihood compared to a zone positioned at a low HTF location, which has a stronger directional bias. In summary, setting a trade from a demand zone in HTF equilibrium while in an uptrend can still offer a decent opportunity, though it's not the ideal scenario. This setup is more about participating in the trend where price hasn't reached extreme levels, providing a balanced approach between risk and reward. Understanding this context allows us to manage expectations and approach the trade strategically. In the second scenario, the only variable that changes is the direction of the price. And this highlights an important point. If the lower time frame LTF zones are positioned within the context of higher time frame HTF equilibrium, and the HTF is in a sideways trend, we do not set the trade. Why? Because this combination results in a low probability, low profitability trade setup. In a sideways trend, price tends to oscillate without clear directional momentum, and an equilibrium location lacks the extremes necessary to capitalize on stronger moves. Combining these two factors creates a situation where the trade lacks both the necessary context and directional alignment to offer meaningful profit potential. As traders, our ultimate goal is to focus on high probability, high profitability trade setups, scenarios where the broader market context, trend direction, and location align to provide the strongest opportunities. In this case, it's better to stay on the sidelines and wait for a more favorable setup that meets our criteria for success. This is our final example, and it illustrates an important nuance. Let's say we have identified a lower time frame LTF supply zone that's positioned in the context of the HTF equilibrium, while the HTF is in a downtrend. If we now wanted to set this LTF supply zone, we would need to evaluate two key factors. Profit margin. Since the supply zone is located in equilibrium, the profit margin is medium. It's not as favorable as trading from a high HTF location, but it still offers reasonable potential because we are aligned with the downtrend. The probability of success is also medium. While trading with the trend improves the odds, the equilibrium location doesn't provide the same level of confidence or opportunity as a high-quality zone positioned at HTF extremes. The key takeaway here is that trading from equilibrium is permissible, but it's not ideal. When we trade with a trend, such as this example of a supply zone in a downtrend, the setup can still work, but it lacks the higher profit potential and stronger probability that comes with zones located at HTF extremes. As traders, it's crucial to prioritize setups that maximize both profit margin and probability of success. While equilibrium trades with a trend are valid, they should be considered secondary to more optimal opportunities at HTF high or low location. I know this is a lot to process, and it's completely normal to feel a bit overwhelmed at this stage. But that's why we've created this action matrix to simplify everything into one convenient table. Take a moment to review it and feel free to take a snapshot. Let's begin by breaking it down, starting with LTF demand zones. We are always allowed to trade demand zones when they are positioned in the context of HDF low or very low location. But the profit margin and probability of success will depend on the HDF trend. Best case scenario, trading demand in the context of an uptrend offers the highest profit margin and strongest probability of success. Even if the LTF zone is located in HDF equilibrium, it's still a valid setup. Also, the potential will be slightly lower compared to zones in low location. Medium scenario. Trading demand in a sideways trend offers moderate profitability and probability. It's not as favorable as trading with the trend, but can still present viable opportunities. Worst case scenario, trading demand in the context of a downtrend represents the lowest profit margin and lowest probability of success. This counter-trend trade should generally be avoided unless there's a compelling reason to take the risk. Critical rule: we can never trade demand zones in the context of HDF high locations, regardless of the trend. Buying from high location is fundamentally misaligned with the principles of supply and demand. Now, let's shift to the LTF supply zones, shown on the right side of the matrix. We are always allowed to trade supply zones when they are positioned in the context of HDF high or very high location. But again, the profit margin and probability of success vary depending on the HDF trend. Best case scenario, trading supply in the context of a downtrend is the ideal scenario, providing the highest probability of success and the best profit margin. Selling from equilibrium is also permissible, but slightly less favorable than zones in high location. Medium scenario, trading supply in a sideways trend offers moderate probability and profitability. While not ideal, it can still be a decent opportunity if conditions align. Worst case scenario, trading supply in the context of an uptrend is the least favorable setup with high risk and low reward. Counter-trend trades in this context are generally not advisable. Critical rule: we can never trade supply zones in the context of HDF low location, even if the trend appears aligned. Selling from low locations contradicts the basic principles of supply and demand, and it is not a valid setup. With this framework in mind, we will now transition into a practical application session where we will apply this decision-making process directly to the charts. You will see step by step how to use these rules in real-world scenarios, making it much easier to translate theory into practice. Let's dive in. Welcome, traders, to our practical application about the decision process. We have always three questions. The first one: what is the location? Second one: what is the direction? And the third one is where to place our set, stop, entry, and our target. We will talk about the uptrend, downtrend, sideways, then location, high, very high, low, very low, and equilibrium. Let's go into our Campus Fund trading platform. Right, we can analyze and execute all our trades here. It's TradingView, right? Okay, let's start here with our Euro Japanese yen, not on the daily, right? We will use the higher time frame here because the first step is we need an answer of the question, what is the location? Okay, means Euro Japanese yen weekly time frame. Remember, guys, on the lesson of the lesson of the location, that means we have to identify the first supply zone and we have to identify the first demand zone. We will start with supply, and guys, it's a high quality zone here, right? Let me enable this one. This is our first supply. I will change the colors very quick to gray. Perfect. Means we we found, or this meaning we found our first supply zone here. Now, the next is to identify our demand zone here. Correct. Okay, this is the supply zone. This is the first demand zone. Price is located here, right? I will talk about different situations, right? Like mentioned before, means the high, low, very low, uptrend, downtrend, sideways. And for that, I will draw some lines here. First, we need an answer of the question, what is the location? Here we are more like equilibrium, but in this case, for this example, I will use a line here and I will move the current price, that's only for this example, the current price to the high or very high area. This meaning we are close to the supply zone or in the supply zone. Okay? Good. The location is high or very high. The result is it's only allowed to short the euro Japanese yen, not to buy. It's only allowed to short the euro Japanese yen. Okay, great. Step number 1, location, right? Supply and demand. We are high or very high. The result is it's only allowed to short this asset. Great. Next step is, what is the direction? Okay, and we will start with an uptrend here. You can see it's low. This is our high. It's our higher low. That's our higher high, another higher low, and a new higher high. Let me draw it like this. And one more, 1 second. Another higher low. Okay, great. Low, high, higher low, higher high, higher low, higher high, and here another higher low. Great. Summary is that we have a location and we are located high or very high. It's only allowed to short. Direction, we are in an uptrend. Great. The third step is where to place our set. Stop, entry, and the target. And why? Great. Let me write that to place the set always on the lower time frame. Let's go from the weekly to the next lower time frame, and in this case it could be the daily, right? And here I will highlight a zone for you. That's our lower time frame zone. We change this, also the colors to blue. Great. And you can see here now the gray zone is a higher time frame location supply zone, and the blue one is a refined lower time frame daily supply zone. Okay, location, it is only allowed to short the asset. Look at this. We are in an uptrend, and if it's only allowed to short the euro Japanese yen because the current price is close to high, very high, right? That means here, if we short the euro Japanese yen, then the profit margin is what? Definitely not the best of the best. The reason is from the higher high to the higher low is that this movement is only the correction. That is not the impulse. You can see that here from the higher high to the higher low, that's only the correction. It's not allowed to violate this higher low. Means here we can't expect a price drop. Let me draw another line, a price drop all the way down. We can't ride any wave here, right? Impossible. It's just a correction trade. And here a correction trade is always less profit margin, right? It is okay. It's absolutely fine if you want to do that, but it is not the best of the best trade. Great. I think the location high or very high and the direction uptrend clear now. Let's talk about another direction, right? Tick in a box for the uptrend, and now we have to talk about the downtrend. I will remove these lines here and I will draw a downtrend for you. 1 second. Okay. Please forget all these candles here. Okay, I will draw for you. I will draw a nice downtrend here. Great. That means a high, a low, and lower high, lower low, another lower high, and here a new lower low. This is our trend. Please forget this candle. That's our trend. Okay, location, high or very high, direction, clear downtrend. Don't forget, it's only allowed to short the Euro Japanese yen. And this one, that is the best of the best scenario. The reason is, here it is possible for us to short, right, the asset and then in the same direction as a trend. Means this is an impulse move. Okay, we can trade the impulse move, and in a downtrend, we are always expecting a new, how could I highlight this? We expecting always a new lower low, right? Means here we could riding the trend wave all the way down from, let me draw it like this, all the way down from this supply zone, the lower high, all the way down to a new lower low. And you can see this setup has the best profit margin, right? We are aligned, the location is aligned with the direction, best of the best. That's a great trade, guys. Always look at this. Okay. Let me remove this. We have one more example for high and very high location, and that is not an uptrend, that's not the downtrend. We are here now in a sideways trend. I have to draw this for you as well. Sideways, guys, we have not really lower lows, not really higher highs, okay? We violated always pivots. We have definitely not a clear direction, okay? That means this is our trend. Clear sideways, not an uptrend, not a downtrend, sideways. Location, again, it's always the same, high or very high. It's only allowed to short, okay, to short the Euro Japanese yen. You can see we cannot really expect a lower low, we cannot really expect a higher high, right? Because we have not a trend here. In this case, we have to use the next opposing zone, and this also on lower time frames. This kind of trades, I mean, they are fine, right? If you're an advanced trader and you see a setup, yes, you can take this one. But if you're a beginner trader, to be honest, I would more avoid these setups. The profit margin here is always less. Okay, it's definitely not the trade that's one of the best, okay? It is a profit margin is always less. The reason is the location and direction is not aligned, okay? Both are not aligned. Great. We are done now with the location high and very high. Let's talk about the location low and very low. I will remove the trend here again, and I will move the price line from the high and very high area. Remove also the lower time frame. Let's go back to the higher time frame. The current price is not located in the high or very high area. The current price is located now in the low or very low area. Okay. This meaning we have to buy, right? It's only allowed to buy the euro Japanese yen. The reason is we are located in low or very low. Okay, good. We are now located here. Trend. For an example, we are in an uptrend again. Let me draw this. Path. Low, high, higher low, higher high, another higher low, and another higher high. Last but not least, a higher low. We are here in an absolutely valid uptrend. Location, right? Summary. Location, low or very low. The result is we definitely want to buy the euro Japanese yen. Direction and uptrend. Okay, guys, this one is the best setup. Or the same like, do you remember the previous example? We are located on the high or very high area and within downtrend. That's the same. Now we are located on the low or very low area and we are in an uptrend. Here, guys, we can trade, right, align with the direction. The profit margin is one of the best. Look at this. We can buy the current price here in the low or very low area, and we could expect what? If we riding the trend wave, a new higher high. Very easy, guys, right? These trades are one of the best. Here, the location is aligned with the direction. We could expect a new higher high. We will violate the higher high, the previous higher high, and with a new higher high. Highest profit margin, right? Best of the best trades. Okay, remove this, remove this. Next example is the location low or very low, but the direction is in a downtrend. High, low, lower high, lower low, lower high, and a lower low. Great. This is our downtrend here, okay? And current price is located where? In the very low or low area. Again, it's only allowed to buy the current price. Here we will not trade the impulse, we will trade the correction. I mean, that's absolutely fine, right? If you want to do that, you can always also trade the correction move. That's up to you. But the profit margin is here most of the time less, right? Less than an impulse move. Okay, and now we have to talk about the last example for the location low and very low. That is a really ugly sideways trend. Again, guys, sideways, we have no higher highs, no higher lows, right? You can see prices always up and down, right? Up and down, there's absolutely not a trend here, okay? And price is located again in the low or very low area. So, of course, you can always, let me go to the next lower time frame, right? Means location, low, very low, direction, sideways. Let me refine the zone on the lower time frame. That's here for our demand side. Of course, you can always buy and sell. That's absolutely up to you. But a recommendation from my side is, if you're in a sideways trend, okay, these trades are not the best of the best, right? You have always to identify the lower time frame, in this case, supply here, and definitely your target should be, you have to place your target definitely to the next lower time frame opposing zone. It's impossible for you to riding any waves, right? To riding a trend wave, because there is not a trend, okay? Right, means, yeah, you can do that, right? That's absolutely up to you. But please for this example, in this situation, sideways, check always your profit margin. That's really important. Great. Now we have to talk about the last example or situation. Let me remove this. And the current price is not located anymore in the high or very high area, and also not in the low and very low area. No, we are located now in the equilibrium, okay? Exactly in the middle between both zones. If we are located in equilibrium, guys, that is never the best idea, okay? That's definitely not the best idea to trade if the price located in the equilibrium area. Of course, you can do that, but as a beginner trader, please avoid these setups. But let's talk about it. First example is, again, let me remove this. First example is, again, an uptrend, okay? Higher high and the higher low. Great. This is our uptrend, but here in this case, current price is located in the middle, right? Equilibrium. There is not really one force, right? We can't identify one clear winner from supply or demand side. No, that's impossible here. The reason is we are located in equilibrium. It's absolutely fine as an advanced trader. You can try it to buy or to sell, right? Especially on lower time frames, but don't forget there is not a big brother, right? We talked already about the big brother, small brother principle. There is not the big brother. We have only the lower time frame zones, right? Or the higher time frame zones, but not the location of the big brother here. Meaning you can trade this one, but it is not really good trade, okay? For me, to be honest, I always avoid trades like this, but it is up to you. I think it makes not really sense to talk about a downtrend and sideways here again, because it's always the same answer. You are in equilibrium. It depends on your trading style, your own trading rules. Maybe you can do that, but that's up to you. Check always the profit margin. That's my recommendation. Thank you for joining, and see you in the next one. I hope you found the practical application insightful. I will see you in the next lesson.